Good afternoon, everyone. My name is Fee, and along with Michael and Avina, we will be talking about the Halliburton case study. Avina will start off with the background and internal review, then I will take over for the external review and the financial performance, and then Michael will take over for the question and recommendations and the conclusion.
I'm gonna talk about the background of Halliburton Company. Halliburton is one of the world's largest providers of products and services to the oil and gas industry. It's based in the United States and founded in 1919 by R.P. Halliburton. After borrowing a wagon, a team of mules, and a pump, he built a wooden mixing box and started an oil well cementing business in Duncan, Oklahoma. In the 1930s, Halliburton established its first research laboratories where the company tested cement mixes and increased the production of oil and gas. Performed its first offshore cementing job using a barge-mounted cementing unit at a rig in the Gulf of Mexico. This was the beginning of what was to become the world's most extensive offshore service. David Leza is the chairman, president, and CEO of Halliburton Company. This company has dual headquarters located in Houston and Dubai, where CEO works and resides to focus on the company. The company will remain incorporated in the United States. Today, Halliburton offers the world's broadest array of products, services, and integrated solutions for oil and gas exploration, development, and production. The strategic issue of Halliburton Company. It's divided by three: strategic formulation, implementation, and evaluation. The mission of Halliburton Company is to create sustainable value by delivering outstanding products, services, digital assets, solutions that help our customers succeed, maximizing production and recovery, realizing reserve from difficult environments, improving operational efficiency. The vision is to be preferred upstream service company for the development of global oil and gas assets. The strategic implementation. First thing, the directors needs to provide effective governance over Halliburton's affairs for the benefit of its stockholder. That responsibility includes the lead director shall facilitate the discussion of the non-management directors to evaluate the performance of the chief executive officer. The chief executive officer's performance in both qualitative and quantitative area, including leadership and vision, integrity, performance of the business, development and implementation of initiatives to provide long-term economic benefit to Halliburton. Second, they have to select, evaluate, and set the compensation of executive management of Halliburton, annually review and evaluate the succession plans and management development programs, conduct periodic reviews of and approve strategic and business plans, monitor corporate performance against such plans, then review the applicable laws and regulations, including the health, safety, and environment, maintenance of accounting, financial disclosure, and other controls. The strategic evaluation. As we see in this picture, Halliburton has a good structure of business. That would be the reason why Halliburton becomes successful. Halliburton has excellent fracture engineering because of the Center of Excellence workflow involved fracture modeling, production data analysis, well test analysis, and reservoir simulation at the beginning of the fracturing process. This is followed by fracture treatment design, materials, and fluid selection. The engineering services in two primary disciplines. Fracture engineering service in cell designing hydraulic fracture treatments and performing real-time rigorous production analysis and well testing to evaluate stimulation strategies and practice. In-depth data plus advanced technology. In-depth dataset related to understanding hydraulic fracture growth characteristic across all the different shale and tight gas plays. This knowledge and understanding provide a unique advantage that can be enhanced when combined with advanced engineering techniques. Halliburton employees feel happy work in Halliburton company because of the good work environment, good salary, safety and organized. If the employee feel happy, they would give good performance and good work for the company. That's what the reason why Halliburton provide a good service to the customer and become successful.
As part of evaluating the external environment, a pest analysis was conducted to see what forces are at play that may affect Halliburton as a company. Beginning with political factors, the increased regulation of the US offshore drilling industry as a result of the Macondo well incident and Halliburton's role in it could result in higher operating costs, extended permitting and drilling delays, and reduced demand for services. With economic factors, there are foreign and exchange risks and limitations on ability to reinvest earnings from one operation to fund operations from another. An example of this would be non-traded or soft currencies for countries with limited or restricted trading markets makes it difficult to trade for hard currency and therefore difficult to convert the profits from the soft currencies. An example would be Venezuela to US currency. Social factors. The growing adoption of renewable energy, which is considered environmentally friendly and capable of fighting global warming. The climate action plan put forward by Barack Obama will see an increase in the use of zero carbon wind and solar energy that could reduce the need for oil and natural gas. With technological factors, if Halliburton can't consistently keep up with commercially viable products in a timely fashion as a response to technological change, then business and value of intellectual property would suffer. But Halliburton can allow others who don't have the technology so that both can mutually benefit off the operation. An example of this would be unconventional plays like extracting shale gas can be capitalized on in countries like China, which lacks the pressure pumping capacity to extract this gas, which is something Halliburton can provide. A SWOT analysis would also be conducted to analyze Halliburton itself and how it should fare against its external environment. Regarding its strengths, a strong market position and diversified revenue stream would protect the company in times of crisis. After suspension was lifted from offshore deepwater drillings due to the Macondo well incident, Halliburton's operating income was expected to decrease by investors, who reported earnings showed growth instead. A strong market position allows Halliburton access to raw materials even when demand is high. For its weaknesses, Halliburton suffers from litigation issues. Halliburton has been subject to several criminal investigations, most recently pleading guilty to destroying evidence after the April 2010 Deepwater Horizon disaster, which incurred a $200,000 fine for Halliburton and agreement to 3 years of probation. Opportunities would be acquisitions. By engaging in mergers and acquisitions with companies with unique technology or specialties and distribution areas, Halliburton can add great value for its shareholders. In the past, Halliburton has participated in mergers with companies like Multichem Group, which made operating income increase in North America by 112.26% from 2010. Regarding its threats, there are renewable energy threats. A decline in traditional power sources like oil and natural gas could threaten the demand for Halliburton services. If we have a look at Halliburton's financial performance over the past 4 years, we see that since the global financial crisis, there is an increase in revenue that has risen dramatically from 2009 to 2012. Since then, revenue has increased from $14,675 billion in 2009 to $28,503 billion in 2012. In 2010, revenues increased 22.4% to $17.97 billion, while the company's profits increased an incredible 59.5% to $1.84 billion. Company profits for the first 3 months of 2011 doubled to $511 million from $201 million the prior year, as revenue rose 40% to $5.3 billion. With an average annual growth rate from 2009 to 2012 of 13.93%, the firm is growing in revenue, but if you have a look at the net income from 2011 to 2012, you will see that profits have decreased. The same can also be said of the profitability ratios of gross profit margin, operating profit margin, net profit margin, and return on equity, all of which experienced a significant decrease in 2012. This can be attributed to higher supply costs, disruptions from Hurricane Isaac, and fracking prices dropping amid an equipment glut in North America, with prices estimated to have dropped 15% in 2012. In 2012, fracking equipment, which is measured by amount of horsepower available, exceeded demand by an estimated 38%. About 15.3 million horsepower was competing to meet demand for 11.1 million. This tells us that the market for fracking is oversupplied. A $300 million charge is also accounted for as an estimated loss contingency related to the Macondo well incident. Yet despite the lower activity levels in North America, the company is experiencing strong growth in its businesses in the Middle East/Asia and Latin American regions.
I'll be looking at the case study question, which is, does Halliburton's increased emphasis on Eastern markets at the expense of North America seem reasonable? Halliburton's increased emphasis on Eastern markets at the expense of North America is a reasonable decision that will help the company's growth opportunities. The move was a strategic one, made after an evaluation of the company's internal and external factors, and the understanding that they had to move to the Middle East to keep expanding. The move of Halliburton's headquarters to Dubai in the United Arab Emirates will position the company closer to key markets and reduce the costs of moving materials, products, tools, and people. By sending its chief executive David Lassar to the Middle East region, the oilfield services giant can gain momentum in its strategic plan to focus on expanding relation with the state-owned oil companies. Upon its decision to move its headquarters to Dubai, CEO Lassar stated that the Eastern Hemisphere is a market that is more heavily weighted towards oil exploration and production opportunities, and growing our business here will bring more balance to Halliburton's overall portfolio. As the CEO, I'm responsible for the global business of Halliburton in both hemispheres, and I will continue to spend quite a bit of time in an aeroplane as I remain attentive to our customers, shareholders, and employees around the world. One of the obvious benefits of moving Halliburton's headquarters to Dubai is Dubai's friendly tax laws, which will add to the company's bottom line. Even though the company is still registered in the US, by relocating the CEO and other top executives, Halliburton can argue that a portion of its profits should be attributed to the no-tax jurisdiction. The issue of tax is good for Halliburton's bottom line, but it has not been good for its image. Some people in the US were outraged by the decision to be based in Dubai, and members of Congress even called for an investigation. Senator Byron Dorgan said, "I want to know, is Halliburton trying to run away from bad publicity on their contracts? Are they trying to run away from the obligation to pay US taxes? Or are they trying to set up a corporate presence in Dubai so they can avoid the restrictions that currently exist on doing business with prohibited countries like Iran?" Senator Patrick Leahy said, "This is an insult to the US soldiers and taxpayers who paid the tab for their non-bid contracts and endured their overcharges for all these years." Henry Waxman, chairman of the powerful House Committee on Oversight and Government Reform, asked Halliburton to explain the reason for the move, raising concerns about the ramifications for US taxpayers and national security. Recommendations. With Halliburton seeing lower returns of its customers and less demand in the USA, they made the decision to move their headquarters to the Eastern Hemisphere to grow the company. Before doing so, the advantages and disadvantages when considering a move of this magnitude needed to be weighed against each other so that such a decision was good for the future. The company needed to think about whether this move was reasonable, so that threats relating to not moving the company could be addressed in terms of shifting the focus away from North America. Threats like the reaction in the USA once the company announced their plans, stakeholder satisfaction, and how the company would cope in being in a region totally different to what it is used to would need to be assessed. Looking at the move, I think it is fair to say that it is an example of excellent strategic management because the level of growth in the area is huge, and this has created a great opportunity for Halliburton. It is cheaper for them to be based in the Middle East, and the resources they require are easier to come by. Looking to the future, Halliburton needs to identify where the best growth opportunities are to keep its earnings moving in the right direction. If you look at the financials internationally, the company did very well. But what is encouraging is that Halliburton looked favourably on the near future for domestic drilling, noting gains in margins and some pricing power expected to enhance profitability from rising well production, and this led to a 2% revenue increase in North America. Simply put though, the demand in the US is not as high as the Middle East and Asia. This is a challenge for Halliburton, especially with the exploration and production companies getting a lot shrewder with expenses and becoming more efficient with drilling practices. One of its competitors, Nabors Industries, cut its second quarter guidance recently, citing such efficiency gains as having reduced demand for North American pressure pumping equipment and services. If those trends carry on, it could have an impact on Halliburton's results. Overall, however, the international opportunities represent a huge part of Halliburton's future growth. In China, Halliburton has gained a foothold in the nascent shale gas industry, holding out their expertise to try and woo local players in the Chinese energy sector. Meanwhile, deep water players around the world could help Halliburton immensely, as deep water rigs continue to command high prices from companies seeking their fortunes in large oil finds in hard-to-reach places in the world's oceans. One recent smart efficiency move that Halliburton made was in July 2013, and it was a deal with the Nevada Environmental Services to provide water recycling services for its hydraulic fracturing practices. By reusing water in dry areas like the Bakken Shale play, Halliburton should get cost savings and appease environmentally minded critics of fracking. In conclusion, looking at the information we have discussed in our presentation, we believe that Halliburton should put more emphasis on the Eastern markets, including the Middle East and Asia, to continue experiencing growth in revenue and profits. At the same time, Halliburton needs to work on their litigation issues, while continuing to adhere to regulations and international laws, and pursuing environmental programs to improve their image.